Welcome back, friends. My name is Deepak More and you are watching my YouTube channel, TheIndianOptions.com. Today we are going to discuss a very important topic, that is premium's reaction to market crash. And this video is in the section called as ready to trade. It's a bit complex. Things are discussed here, so if you have not seen another videos like from option basics and damn risky stock options, you should first see all the videos in those sections before coming to this ready to trade kind of section, because now we are going into more complex zones from here on. First of all, what is premium, right? Now, in the real life examples that we have taken in our basic videos, we know that the premium is the token that the buyer pays the seller when the contract is open. So the question is like, who decides the value of the premium should be, what the value of premium should be, right? It is determined by a very complex formulas called as Black-Scholes model. Okay, don't worry about this. It's not really very important how it is calculated. It is important to us to remember that premium is the addition of two very important components. One is the premium is equal to addition of intrinsic value plus time decay. There are also a lot of small factors which also play a very important role in the price of the premium. That is time to expiry, then strike price distance from the market rate right now where the market is trading, and what is the implied volatility, what is the underlying security price, and what is the probability of your event happening or not. Okay, so these are all few points which determine the value of the premium. But for practical purpose, all those points, they are a little bit not important. Only important point is like premium is equal to intrinsic value plus time decay. Now that's what I am explaining here in this sheet. Now brief explanation of the premium. Now here I have taken the option chain, and you'll see that I'm taking two examples here. One is in the green rectangle, that is on put side, and I'm taking the strike price of 12,100, and on the call side I'm taking the example which is shown by the red rectangle. It is strike price is 12,500. Now if you see what is the premium for that, premium for that is 112, and premium for the put side was 102. Okay, now both of these contracts, now you see the red dot in middle, that is market trading at. So both these points, they are like 200 points away from, both the strike prices are 200 points away from the central market trading act, right? So if you just observe some more strike prices as we go away from the market trading at the you'll see that the last trading price is like decreasing, by 100 points or by few points here and there. Okay, so for practical reasons, you just need to remember that premium is equal to intrinsic value plus time decay, and below we have shown that the today is like 1st of July and the expiry is 31st of July. So days to expiry is 31 days. Okay, now the strike price distance, so premium is equal to strike price distance from market trading at plus how many days to expiry, or how much implied volatility is there. So you can see the implied volatility. I have put it in some oval circle there, and what is the intrinsic value, what is the price of underlying. So all these things, they determine what is the value of the premium. Now in this sheet, it's for the premium calculations I'm setting. It's an option chain, as you can see, and right now the market is trading at is 12,282.70. Okay, and expiry date is say 26th of December, and call side, the top part is always in the money, and the bottom part, which is the white part, is always out of the money. And on the put side, the top part is always out of the money, and the bottom part is always in the money. Okay, so out of the money is always in the white background. Okay, now here I am taking two examples. I am trying to show you what is the difference of how the intrinsic value gets added inside the premium. Okay, so that's what we are trying to understand here. Now I've taken two examples here. If you see the strike price of 12,100 on the call side, I'm saying is showing the premium. It is showing the premium as 288 rupees and 65 paisa. And for the same expiry, if you look at the premium of 12,450, now that is again out of the market. So it is showing the premium as 3 rupees and 50 paisa. Now you notice the difference between 288 rupees and 3 rupees. It's quite a lot of a difference. Now why there is this difference is what we are going to discuss here. Now today is so there are only 3 days to expiry. So today is 23rd of December, and the expiry is on 26th of December, right? So there are 3 days to go, and the market is trading at 12,282 right now. Now if your strike price is in the money, now I have shown in the great red text and the green box just right above my head. So if your strike price is in the money, then premium is equal to intrinsic value. Now intrinsic value is what? Intrinsic value is market trading at minus your strike price. Now what is market trading at? Market is trading at 12,282 minus 12,000. So that 282 becomes the intrinsic value inside the premium. Okay, now premium, it is showing that it is 288. So out of that 282 is the intrinsic value, because the market is trading at right now is 12,282, and the strike price that we are looking at right now is 12,000. So the difference between that is 282. So 282 is intrinsic price, intrinsic value of the premium. So now if we do the math, it just becomes the time value in this premium is 6 rupees and some change, 65 paise or so, right? 282 rupees. So 288.65 minus 282, 12,282, you'll get like 6 rupees. So 6 rupees is the time value in this. Now if your option is out of the money, as you can see in the blue box there, if it is out of the money, and we are talking about the strike price right now of 12,450. Now in this it is out of the money, so it doesn't have any intrinsic value in that. So whatever the premium that you can see right now, that is 3.50 3 rupees 50 paise, that is all the time decay, which means that if the market closes at 12,282 right now, today, if that is what will happen, then this 3 rupees is going to become 0, because anything out of the money at expiry becomes 0. Okay. Now even take the example of say 12,350 on the call side. The premium it is showing right now is 21 rupees and 25 paise, 21 rupees 25 paise. So if in the next 3 days, if the market does not go above to 12,282, then this 21 rupees is going to become 0. Okay, so that's all I want to show. So just to conclude this slide here, if your strike price is in the money, then your premium has the intrinsic value and time decay. If the strike price is out of the money, then your premium has only the time decay. Okay. Moving on to the next slide. Now in this next slide I have taken an example of the Nifty chart, because I wanted to show a few things here. So this is the Nifty chart from May to July, almost like 2-3 months of the Nifty chart, basically the values of Nifty. Now in this Nifty chart you will notice that the market was more or less flat the whole time. It didn't go much from 11th, okay, and from 14th to 16th May, 14th to 16th May, you will see that there is a very big dip there. Okay, now at this point, so on 14th or 16th May, the market was trading at 11,200. Okay, and then on 5th of July, again the market crashed. On 5th of July, that was like when the Modi government declared their budget, and it was not really very good budget as far as the market is concerned. So the market really dropped. Okay, so that happened on 5th of July. So you will see that in next couple of days, the market dropped from 12,000 to 11,500 in just matter of few days, right? Couple of days, right? So considering this, now the whole this presentation, what we are talking about is how our premiums react to the such kind of market crash. So we are going to discuss that in next few slides. Now in the next slide, crash reaction to the premium, right? Crash reaction. Now the same chart, the Nifty chart, I have taken again back in this slide also. I have just minimized it a little bit and put it on the left hand side top corner there. Now you will see that 14th and 16th, there are two W marks there. So that was when the market was had crashed or something. And if you see the 18th expiry, 18th expiry date, just a chart below that, you will see that the market has that peak is there, right? So the market, the premium was 140 at that point of time, and as soon as the market crashed, it became 160. Okay, and then again it started going down, 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 because there were not many events happening there, and on 18th July it became zero. The premium goes to zero because the market was trading above 11,200 on 18th of September, 18th of July. Now just take the same graph, same contract, only the expiry date is different. Expiry date is 1st of August. Now you can see that during the budget time below at around July 5th or so, the premium was around 10 rupees. Okay, but when the market crashed here 500 points or so, here the premium it increased from 10 rupees to almost like 60 rupees. So which means that the premium increased 6 times in that 1 day period, right? On the other hand, if you see the 18th July expiry, it did not matter much because it was almost around 1 rupee or something, and it went to 17-18 rupees. But again in next couple of days it went back to zero because there wasn't much time left for the premium to make a very big move or something. But in case of 1st of August, there was still a lot of time spending, almost a month still ahead. So 15 to 20 days I think so ahead. So in that case, if you see that the premium went from less than around 10 rupees to around 60 rupees or so, and then in next 4-5 days again it went back to somewhere around 18 rupees or so. So and it did not go to zero because there is still some time left for the expiry to happen. So it did not go till zero actually, it just went until 16-17, and so for the last week it was somewhere trading around in that. So here what I wanted to emphasize on this sheet is that when the market crashes, the premium, the way they actually react to this situation is really very different based on the expiry date. Now in 18th July, the expiry date was not much, it was just very close by. That's why the premium did not react much. It just went from 2-3 rupees to 20 rupees. Again, it is like big leap if you look at it that way. From 3 rupees it jumped to 20 rupees, means almost like 6 to 7 times it increased, and then but again it went to zero because the time was not there much. Okay, now moving on to the next slide. Now in this next slide, I'm trying to explain you, it's more closer view on how the premiums reacted when the market crashed. Okay, now in this example we are seeing that this slide, the expiry date is 27th of July. Okay, 27th of July, and the market crash has happened 2 times, before July 5th that is the market crash that happened because of the budget. And in that situation, the market, this premium was somewhere around 25 rupees or so, and it shot up till 100 rupees, which means 4 times it increased. 4 times it increased, and it has still 2 or 3 weeks to recover. So again it went down, again it crashed, again it went up. But if you notice that if there is 2 or 3 weeks to expiry, the premium would go maybe 3 or 4 times only, or maybe 5 times. But if the distance is 1 week to expiry, at that time the premium increased 6 to 7 times. Okay, 6 to 7 times. Now, when if you have seen my zone videos or so, premium zones, now you will see that if the market, if the premium is around 20 rupees or so, which means that the premium is in blue zone or purple zone. In that situation, if the market crash, we shouldn't wait for it to recover. You can just, because all the juice is already extracted from that contract. So you should just quit the contract and come out of the contract before you start making loss. So take whatever profit it is, just run away. Okay, now in this slide, what I wanted to explain was that if there is still time to expiry, the market might come up and it might actually recover. So there is no need to really panic. Now in the second situation, now I am saying that it is 2 weeks to expiry. If it is 2 or more weeks to expiry, then the premium usually goes maybe 2 times, 2 or 3 times maximum. It will upgrade. Now same example I have taken for 1st of August. Now the expiry is like 3 to 4 weeks is there to recover. Now again the budget happened on 5th of July, and the market went from 22 rupees till almost 120 rupees. So 4 or 5 times the premium increased, and then again after a few weeks or so, maybe a couple of weeks, again it dropped back to the 20-30 level, and then again when the market crashed it went up. So the amount of time you have until expiry, it plays a very important role in how much the premium will go up and down. So just be mindful of that. The whole reason of this explaining is that when the market crashes, the premium, it really goes, shoots up or shoots down or something. So there's not really big thing to panic here, because if there is a time to expiry, it usually it will recover. But if it is a trading behavior that you cannot wait or something, then just put a stop loss and get out of the market. So every day in the morning you will have to check out what open contracts are there and call your broker and set up your stop losses for the day, and then you are okay. If the market crashes, the stop loss will get hit, and you'll come out of the contract anyway, right? So you need to really make your conclusions accordingly, like how you want to do your trades, and just keep in mind how the market would react based on how your premiums are going to react based on the market crash or market soar. Okay. So that's about it from me in this video. Thank you very much for watching, and please subscribe to my YouTube channel, and please share this with your friends. Have a nice day, and I'm going to actually upload this PPT on my website, that is www.TheIndianOptions.com. Please visit the website, become a member, and you can download all these presentations and you can study them looking at the videos and studying them. It's going to be really helpful. Thank you very much, and you have a nice day. Bye bye.